Good afternoon, everybody. Sorry for the surprise. Oh, somebody switched the lights on. Hope they're LED, because apparently the next session is climate change, so if they're LED, good for the climate. Anyway, we're on collaboration, or as somebody who has paid for the front page of the Financial Times, collaboration, a simple answer for complex issues. My two colleagues, Dr. Barbara Weber and Mike Weston, will be talking about the collaboration that they've been involved in. However, before we start, I'm going to do a quick show of hands, and then there's a couple of voting questions. So, on a show of hands, who is a fund manager here? Right, sadly, you're not going to get a half-hour diatribe on LGPS investment pooling for me. We're actually going to talk about collaboration. Are there any public sector funds here besides Phil? Yes. And private sector funds? Good. Okay, so to start the proceedings, we have a question on the screen. Right, so using the voting machines, which I hope you've got, could you please vote, are you involved in any type of collaboration with another pension fund? Yes, no, or no but thinking about it? And we shall wait a few seconds for some responses. Okay, has everybody voted? Can we see the results then, please? Right. Okay. Who is telling the truth? I do not believe that one. So we'll try another question. Right, being honest. That's better. That's better. Yes. So 85.7% aren't. So that's a wonderful opportunity, Mike. And 14.3% are thinking about it, which is probably an opportunity for both of you. Okay, and now, what asset class do you think is most suitable for collaboration? Equities, bonds, infrastructure, or private equity?
You didn't put real estate in there.
Oh, we could add real estate, but that's probably blow the technology.
Okay.
And let's have a chance to actually press a button this time, please, guys. Okay, shall we see the results then?
Take some water.
See, collaboration. Yeah. They're sharing water.
They're sharing water.
And the results are... Oh, that's interesting. So a small majority think equities, a reasonable number on infrastructure, and a small number on bonds, so that we could perhaps expand that in a question and answer session. So the way we're going to run it is that Barbara's going to say a few words, Mike's going to say a few words, and then we're going to throw it open for audience participation, which means A, you have to stay awake, and B, you've got to ask questions. Quite important, the latter of why it's going to be a very long, quiet session. So I'll turn over to Barbara for her introduction.
All right, thank you, Nick. My name is Barbara Weber, and the reason I was asked to join this panel is that in Switzerland, a group of pension funds has put together a platform for joint infrastructure investing. So that is an infrastructure platform which, in a way, as you will learn in a moment, is similar to PIP, with some, of course, local differences. Now, in a nutshell, how it evolved, there was a group of about 25 pension funds, and we don't differentiate that much between public and corporate funds in Switzerland. Doesn't really matter when it comes to sitting together and discussing themes. So there is a group of Swiss pension funds, to be correct, it's the Germans and the French speaking, they kind of don't talk that much with each other. So it's predominantly German speaking pension funds. And they didn't want to go with any of the products which are offered by the essentially two big banks and then some other fund manager. So they felt they want to do their own thing, or at least they were wondering whether they could possibly do their own thing. The reason they didn't want to go with the banks is kind of the typical reasons why they felt maybe the interest alignment isn't exactly right. They were partially disappointed from certain products. They clearly always complain about fees. And so, so there was this idea. And I was called in to help them assess, to structure this. And of course, the main question when you want to collaborate is, can you agree on a more or less set of goals, what you actually want to achieve with this? Otherwise, you will not end up with a joint structure. So in that context, or in that session, we basically had, they did manage, the 25 in the room, they did manage to agree on a reasonable kind of risk-return area where they wanted to be in. They were all in agreement that it should be long-term, so the structure we have now is an evergreen structure, which can be opened up at discretion, basically, which means the rule we established there is whenever the capital has been invested, it can be opened up again. And then there's a first right of those which are already in, and then other people can be invited to also put money into it. Maybe I should not forget to say, currently the platform has 450 million. That is kind of the first, it has been set up 2 years ago. It's now, 18 months ago. And it had 2 closes and cornerstone investors of 300, and then a year later another 150, so it's 450, and of that about good 100 million, 120 or so are invested now, so just to give you an idea of size. And there are 17 funds in there now of very, very different size, and which basically gets me back to why would people from different size, which can possibly also do that themselves, actually want to do this. But maybe this is part of the discussion. I currently just stick with the description quickly. Well, I think what's important, what was important in structuring this is to say, okay, who is going to take investment decisions, and who oversees whom, so that you have governance there, but that you have professional investors there, that you have a fee structure which actually seems to be better than maybe a fee structure they could have bought in the market. And very important was also, of course, what's the cash flow profile, what's the liquidity possibility. So all these issues came into play, and I suppose we will have enough time to kind of develop this further during this discussion and to come to details. But in a nutshell, this is the scheme, and given I was asked to help them set it up in the first place and help them write the strategy, I'm now on the investment committee of that investment platform. My background is I'm an advisor. My firm is B Capital Partners, is an infrastructure investment advisor, so we do nothing but advising institutional investors in their infrastructure investments, and therefore I guess they felt I have sufficient competence to help them do this.
Okay, thanks, Barbara. Mike, over to you.
Thank you, Barbara. Thank you, Nick. Great.
Technology.
I was earlier in the day. I was in here in a session with Professor Hans talking about improbability theory, and one of the laws that he came up with was the law of large numbers. So I couldn't help thinking, if you got all the pension schemes together in a room, the law of large numbers is some of them would collaborate with each other. But given that this conference and the October conference about the only time all the pension schemes get together in a room, that's probably not a great basis for collaboration going forward. But it's fascinating theory anyway. So I was given the task by Nick of talking about public and private sector funds, similarities and differences, and the impact that has on the desire and ability of those funds to collaborate. And I think based on doing that, based on the experiences we've had at PIP over the last 3 or 4 years, where we have both public sector and private sector funds collaborating to build the pensions infrastructure platform, to design and structure the PIP fund, which publicly launched yesterday, and now public and private sector funds working together to see how we can extend our collaboration to make PIP, or to offer PIP as a ready-made infrastructure solution for the wider LGPS community. I was specifically asked not to talk about infrastructure because Barbara can talk about infrastructure in Switzerland. And I've done a talk about infrastructure already today on an update for PIP. So this has been an interesting kind of exercise to think about the similarities and differences in the schemes. And I've got two lists on the screen, similarities and differences. I deliberately didn't put which side's which, but it's not that hard to work out which is which. So as I was just thinking about where the similarities and differences are, the fiduciary duty is fundamental across all schemes. Clearly, schemes have a duty to provide the benefits accrued to their members, and to do that in a way that is right and proper and delivers on those duties. Scheme oversight also very similar in the sense that both public and private sector schemes overseen by trustee boards and councillors, so not being negative in any way, but overseen by people who are not pension professionals, so that gives a different sort of viewpoint in terms of how schemes go forward. All schemes suffer from the same valuation and accounting rules. The 3-year cycle applied to sort of very long-term assets, which is not great, but there's a common basis of valuation and accounting rules. Outsourcing also seems pretty similar to me. There are a number of funds in both public and private sectors who have their own in-house teams and ability to do elements of asset management and legal and operations. But there are also many schemes that outsource all of the asset management and the professional services to pension schemes to external parties. Regulation was interesting, because clearly TPR have oversight of both public sector funds to an extent, and certainly private sector funds, although specific government regulation of LGPS is a bit different, something you benefit or suffer from, that private sector don't. And then size range, again, in both sectors there are a few very large funds, and equally there are a lot of smaller funds. Certainly in the private sector there's a very skewed distribution, so a small number of very large funds and then an enormous number of much smaller funds. So the size range is common. And then start thinking about the potential differences. Well, the one at the top of my list was sponsor covenant, because thinking about public sector funds, ultimately, and clearly there's some debate about this, but ultimately, if you run all the way back, the government is the ultimate sponsor, and the issue would be would the government step in? Would the government ultimately pick up the tab? Whereas clear in private sector that the covenant is the employer of the scheme, and there are very many different strengths of sponsor covenant in the private sector. So that I think is a big difference. The membership profile, private sector, gross generalisation, I know, private sector generally closed, public sector generally open. That has an impact on investment strategy. And clearly, if you have a very strong sponsor covenant and an open scheme, that would lead you to a particular investment strategy, i.e. more risk, longer term focus. The converse if you're closed with a weak covenant. So big potential differences in investment strategy. And also, most private sector schemes are on a route to de-risking now, whereas I guess in the public sector that is not as prevalent. Benefit structure is an interesting one, because one of the things I learned when I came into pensions kind of 10 years or so ago is that people seem to regard pension schemes as a homogeneous unit, when in fact each pension scheme is pretty different in terms of having their own particular benefit structures and trust deeds and all that sort of thing, whereas yourselves tend to be much more similar across LGPS. So where it doesn't happen in the private sector, it does more in public sector. Disclosure also interesting in the freedom of information requirements that the public sector have. It was interesting, we experienced that ourselves in the last couple of days, where we were fortunate enough that Strathclyde approved an investment into the PIP fund. And of course, when the papers went to the investment committee, they were put up on the website and it was out there for public consumption. So effectively, we as a manager were looking at well, the news will be out. That doesn't apply to private sector funds to anywhere near the same degree. Localism also really quite topical. And just thinking about it, I suppose it's quite obvious in a way. If you're a local authority, public sector fund based in a particular location, you inevitably have a degree of local focus. Whereas as a corporate scheme, you're an employer. You have operations all over the country, possibly overseas as well, and the head office of the pension scheme can be anywhere. So less local focus, especially as major employers have tended to. There are few major employers in particular locations anymore. So the pension scheme membership is much more diverse and therefore less local focus. Regulation I mentioned for LGPS. Time horizon's the other thing, and that links back, I think, to investment strategy and sponsor covenant, a longer term or shorter term, depending on precise strategy and covenant. So those were the. I'm not assuming that that's an exhaustive list, but it was a list as far as I could come up with. So those are the similarities and differences. So in terms of helping and hindering collaboration, so it's not a hugely innovative colour scheme. The green ones I think help, and the red ones I think hinder. So the fiduciary duty, oversight, valuation, they're all the common factors that all schemes have. So you can, there's some common understanding. And I think the benefit structure was really interesting, because I think that's one of the reasons why it's difficult to get pension schemes to come together, because the benefit structures are different, and that implies different investment strategy demands. So in public sector, where the benefit structures are much more similar, I think it makes it just a lot easier to collaborate than private sector schemes. And then the others, in terms of hindering, I think to me it comes back to all the covenant, the membership profile, the investment strategy, the things that actually drive what pension schemes invest in on a day-to-day basis, and the time horizons over which they invest. Because if those are different, then it's very difficult to collaborate, because your aims and objectives are going to be different. And size range also an interesting one. One of the things that has made PIP successful in the 4 years that it's been going, I think, is that the founding investor pension schemes were all of a similar size. So they all knew, or they had similar experiences of what they could do being a particular size, the constraints that came with the size, but they could all identify with each other. So that's my quick run through of the impact on collaboration. And I think if you just when I was thinking about it and concluding, is that for collaboration to occur and be successful, I think you need a common outlook, you need common aspirations, you need common objectives, and a belief that there'll be mutual benefit as a result. And ultimately, I guess that comes down to trust amongst the various collaborating partners. But none of that, when you think about it, none of that is particularly a preserve of pension schemes or public sector or private sector or pension schemes as a niche. It's pretty common, I think, in terms of basic human business fundamentals. If you're going to collaborate with somebody you like and you think you can get on with. I think that's really the basic determinant. You collaborate with people you think you can get on with and work with.
Yeah, I think that's a good one, because it's like, like private life, isn't it? I mean, why would you go in bed with somebody you don't like? And so I think collaboration makes a lot of sense. I think size, at the end of the day, doesn't matter. In fact, what we observe in this in the platform where I'm on, or where I was also, which I saw coming together, there are two very large pension schemes, one relatively large pension scheme, and then up to rather smallish ones. And there are some which can write 150 or 100 million ticket after the other, and they would co-invest where they can. And there are others which have made their 10 million contribution to that fund, and that's what they can afford. And yes, what is probably true is that while de jure they all have the same rights, de facto the bigger ones tend to have more influence. But this then comes down to that question of trust. If you feel if you have done your due diligence, regarding your partners, and you feel you, by and large, share similar goals, then they are reasonably happy to go with the decisions or let them be somewhat kind of guided to a certain extent, because at the end of the day, by the large ones, but at the end of the day, the investment committee, which is only professionals, it does not have any pension fund guys on there. So basically, the whole idea was keep the pension funds on the board, and so they can supervise this all and feel good about it, right? There's one delegate from the board, but just one, right? And they picked who that should be. There are 8 or 9 people on the board. We just had one addition. And so one person is attending the investment committee calls or meetings, not always, but mostly. If he can't make it, he can't make it. We would not have an investment committee meeting only because the person can't do it. But he is involved in the communication. So that guy can flag if he feels there might be something which isn't in line what the investors might want. That's it. And the rest of the decisions are taken by the investment committee. And again, these are all professionals in the industry with all the pros and cons, right? The pros are that they are in the market, they have knowledge, they have experience, they are doing the deals, so they know where they can source. There are also, of course, conflict of interest, at least there are potential conflicts of interest, and they are dealt with. We have identified rules, and it's a very, in that regard, the Swiss are super easy. They don't write long lists, they don't let you sign a million things. They just say, well, you know what, if you have a conflict, then just raise your hand and inform everybody. And since nobody wants to, look like an idiot that he hasn't, that's how it works. And actually, it works. And so this whole thing of, what's pro and what's con, and I think Mike did a great job in trying to fill it out in the first place. But I think in real life, and so I fully agree with your conclusion, if you like somebody and you think you would like to do something with that person, be it, doing business or getting married, you kind of see what works, right? You see the positive part of things. And you eventually say, well, I guess I can live with X and I guess I can live with Y, but by and large, it seems to be okay. And I think it's the same when you collaborate. It's always a compromise. Life is a compromise, right? So it's the compromise there as well. If you think it's a good one, go for it. Because certain kinds of assets, I think it's less the case for listed, but unlisted assets in particular, there is a matter of size. Certain kinds of investment don't come in small sizes. They don't get offered to you in small sizes. Even if you learn about it, you won't be invited into the crowd. So unless you have that certain size, you either have to go back to the fund manager mechanism, which, nothing against it, but if that's where you try to get out of in the first place, then doing it all by yourself will reduce your universe probably substantially in certain sectors. And so if you want to open up that universe, which I think it's always good to have a universe as big as possible, because then the chances of you making good investments are just higher, right? Then it makes sense to collaborate to have that size effect. All right, stop for now.
Thanks, Barbara. This is your conference, so this is your chance to ask 2 experts, not me, these 2 experts on collaboration. So do we have any questions from the floor? If so, gesticulate madly and somebody will stick a microphone in front of you. Please gesticulate. It's your conference. If not, we're going to have a very quiet 20 minutes. That's over there. Okay, and over here.
Thank you. Daniel Brooksbank from Responsible Investor. How does the LGPS pooling initiative from the government fit into this? It's interesting to get some views on that. I mean, I think that's quite an interesting development. Hasn't really come up in this meeting.
I was rather hoping it wouldn't come up either. Clearly, part of the LGPS pooling initiative, says he, choosing his words remarkably carefully, is that the Chancellor believes this will free up money for investments in infrastructure. The argument being that infrastructure projects are so large that individual LGPS funds won't look at them and are unable to invest in them because they're too big. Now, if you wish to believe that, you may believe it. The reality is that LGPS funds have been looking at things like PIP. I mean, Mike mentioned that Strathclyde has signed up, and I think originally there was a London fund that were involved in the initial discussions. Will pooling of investments lead to more collaboration on infrastructure projects? I don't know. But what I do think will happen is that there will be peer pressure, if nothing else, on LGPS funds to make allocations to infrastructure. And if those are amalgamated across a pool, that will be a significant sum of money that could be invested in infrastructure. I am also aware that there is at least one LGPS fund that is looking to set up a national pool. But I hope this is all Chatham House rules, even though you were a journalist. Nope. Thanks.
I mean, I think from the outside, it's quite interesting that at the moment, what is it? Around about 2% of LGPS assets are in infrastructure.
It's probably less.
Maybe less. Maybe less than that. So a small proportion of assets in the whole scheme in infrastructure. Yet there are 4 criteria to assess the merits of various pooling proposals that are put together, and the ability to invest more and efficiently in infrastructure is one of them. So actually there is clearly a focus on infrastructure that is disproportionate to the amount of assets invested in, but that's one of the reasons, I guess, to increase that. And we would support the idea of a national pool on the basis that infrastructure is a scale. There are certain benefits of scale in investing in infrastructure. So collaborating on a national scale gets you more of those benefits of scale than 6 British wealth funds all doing their own thing in infrastructure, all taking cost and time to create their own infrastructure investment vehicles of whatever type, and then potentially all bidding against each other for the same assets, which wouldn't be great. So collaboration at a national level to do an asset class like infrastructure seems to be a sensible way forward. And if you look back 3-4 years ago to the reason that PIP was set up in the first place, and there was some government kind of initiation in all of this, although it was taken on very much by NAPF and the pension schemes, was to provide a mechanism for schemes to collaborate to improve and increase the investment in infrastructure. Roll forward now to LGPS, it's to try and create a mechanism for funds to collaborate and invest and increase the amount of infrastructure. So there's a certain symmetry there, and that's why we would say, having done 3 or 4 years getting PIP up and running, then PIP could be a solution for that infrastructure investment need. But clearly it's only a solution if it's something that schemes would like to collaborate with.
Okay, thanks, Mike. And then we had a question down here.
Yeah, Mike, obviously the PLSA has done a good job in launching the PIP. Still early days. As I look forwards, obviously, as you pointed out, many pension funds, DB schemes in the UK are de-risking. So my question really is, well, there's 2 elements to this. The first is, on DB, do you think that infrastructure has a place as a kind of a proxy for a de-risking asset class on the basis that yields are so low? And then secondly, whilst it's a DB strategy, I've got the mic, so I'm going to ask the question, why is there such an underuse of infrastructure in the DC world when it has such great characteristics, apart from obviously the liquidity challenge?
Okay, great questions. Thank you, Weston. DB World infrastructure and DB World. Yes, I think it's fantastic asset class for the DB World in a de-risking strategy. So I think if you, clearly this will be a gross generalisation too. If you project forward DB schemes, what will the ultimate de-risked portfolio look like? And it will probably look like something that has 70-80% of assets in very much liability matching type assets and an LDI strategy, and 20% that still has an ability to generate returns of some description, but low risk, low volatility return, relatively low returns, but returns that if you are fully funded, if you still have a small proportion, maybe 20% of your assets in an asset class that could generate a return, just in case the rules change or just in case mortality assumptions change, and actually, whereas you were fully funded one day, you might not be fully funded the next. So having an asset allocation that still gives you the chance to catch up that, rather than having to go back to the sponsor for additional contributions when you thought you were already fully de-risked. So I think infrastructure has two roles, partly the LDI role, but partly as a provider of relatively low risk returns that unless index-linked gilts give us a real yield of 2 or 3% anytime soon, then there's still a role for infrastructure over the long term in funds.
May I just jump in? I would just like to be very clear. Infrastructure is not, the kind of medicine to cure everything, and also the variety of infrastructure assets in terms of risk-return profile is about as broad as the variety of hedge funds there are. So I would be very careful to not generalize, and I know Mike, knows better. It's just easy to kind of generalize, but so I wouldn't want to generalize that any infrastructure asset can deliver those long-term, relatively predictable returns to match liabilities. But there are certain, and I don't think it's even an art. I think it's just a matter of kind of doing your homework to assess which ones are suitable and which ones don't. And the ones which don't doesn't mean they are not ugly, they are not like an unwanted child. All they are is they just have a different risk-return profile, and they fall more into the bucket of maybe private equity, typical private equity, because at the end of the day, infrastructure is a private equity investment, very, very straightforward, just with a slightly different risk-return profile from the typical private equity investment as we know it. So I think any infrastructure, is generally interesting. It just depends for what. And I think there is this rather large bucket of those which would be suitable.
I think I'd categorise it as a private asset investment rather than private equity investment.
Yeah, but it's in the way.
Okay, guys. End of argument.
Equity.
We have another question.
Hang on. I haven't answered Rustin's DC question. The DC question for me, I look at it, the type of infrastructure that we're focused on, so relatively low risk, low return,
predictable
inflation link.
Yeah. Mm-hmm.
That's the type of asset that for me, if I'm in a pension drawdown situation, that's going to give me a regular income stream. So it's annuity-like characteristics, but also a return that's higher than gilts, has a role in the build-up phase of DC funds at all. I think ultimately, why is it not used? Liquidity is one issue, but cost is the other. So the 75 basis points cap. There aren't many infrastructure offerings that would fit within that cap. We believe that there's an opportunity for PIP there. There are lots of opportunities for PIP. We had to focus on sort of getting the platform up and running, and now we're up and running. Then we can start focusing going forward on those things. But ultimately, I think the cost is the issue, along with liquidity.
Nick, I'm sorry to say I also have a question about the LGPS, but I suppose it is a live collaboration, so certainly relevant to the session. But we've been encouraged to believe that partly the consolidation of the LGPS is about driving efficiencies as well as shifting allocations towards infrastructure. I'm particularly interested to hear your view and the other panelists' view on what investment decision-making is going to look like once you take officers from 89 authorities and elected members from 89 authorities, and you boil them down into perhaps 8 CIOs or however it's going to work. Who's going to make decisions for the LGPS funds?
I think that's if I'm being really honest, is the great unknown. The theory, the documents say that asset allocation, investment strategy shall remain at a local level, and that implementation should be done at the pool level. Inevitably, we're all human. I can see that the range of choices available to my counsellors when setting investment strategy and allocation. So we have very specific equity mandates that I don't think anybody else has for a very specific reason. In 4 or 5 years' time, we're going to find it very difficult to argue why we should retain those mandates. And clearly, Treasury's point of view initially was it should all be passive. Why do you want to go active? Because you lot can't choose managers. Well, if you look at my website, not my website, my pension fund's website, you will see we published the value added from our active managers. It happens to be all emerging markets. It's 3% of our fund value that's been added over the last 9 years. Why would I want to go passive? But sorry, that's just me going on a handle again. How is it going to evolve? Yes, I think you're right that if these pools are going to be efficient, they will be tightly staffed. There will be CIOs. Now, the CIOs should be making recommendations to asset allocations up to the client, and the client should be taking that on board and say, I've given discretion to the CIO within these parameters. If you think equities are cheap, you can have a range of 60 to 65 or 60 to 70, neutral 65. That type of discussion could be had. I think a lot of funds would prefer to keep that at a more local level initially until trust is built up. But it's going to take a long time for trust to be built up. Counsellors have spent a lot of time and a lot of effort in getting to understand their funds and their investments and their strategy. And also then to be told, well, you can't choose fund manager A over fund manager B, but if you want to do that strategy, you're going to get fund manager C because that's what the pool's decided. So it's going to take a lot of learning and a lot of negotiation before we even get to collaboration. This is not my show, guys. This is their show. So have you any other questions? Preferably not on the LGPS. Number 4.
Clive Bouger, Airbus Group. This is not on the GPS, private funds. We heard, I can't remember this morning, yesterday, about value chain and taking cost out, and I think the consultants have taken a bit of a knocking there along the way. Is there not a role for consultants with multiple clients, private clients, to try to get managers to collaborate for a group of their clients, rather than managers, or maybe also for managers to offer more efficient, more user-driven pooled funds?
You got a view, Mike? While Mike's thinking, I would say yes. I do believe that that is an opportunity, but I'll leave it to the asset experts.
I think if you look at the value chains for pension schemes and see, so there are pension schemes, there are the asset managers, there are the advisors to those schemes, and there are, I guess, if you came up with some massive spreadsheet of each pension scheme and each advisor, and there's a degree of commonality, and you could start plugging things together. But I think ultimately, if you look at all this stuff, you have a system there, and you have lots of, I suppose, vested interests amongst service providers. Then you say, where is the motivation to drive any form of collaboration and consolidation? So ultimately, I think it has to come from the pension schemes, because ultimately they are the ones that would increase the ability to pay pensions to their members, and ultimately, and we all know it's difficult to generate returns on assets. Taking cost out of the whole value chain is a way that you could improve those returns without having to try and extract returns from markets when it's difficult to achieve. So it's looking holistically about all the value across the whole value chain. But I think ultimately you have a bit of turkeys voting for Christmas syndrome if you go anywhere else apart from having pension schemes really drive the initiative.
I think this is theoretically doable, but then you can't carry a dog to hunt, right? That's what we say in German. So I think asset managers know what pension or institutional investors in general are looking for, right? And if they don't offer it, they probably have a reason. The reason probably is that they want different returns, you know. So this is nothing to be negative about, it's just rational. So for them it's rational to suggest certain strategies which have certain returns out of which they can take certain fees. Now, if that doesn't happen to be what the investor wants and they don't give a shit, then it's like, all right, either you think about it and think it might be a good model after all, or you don't want to do it, which is fine too, and then you'll see other people offer what the client seems to want. And maybe for that long, you might still be able to convince somebody that actually, this is blue, while you keep offering him actually green, right? And at some point, the guy will realize that you keep saying it's blue, but he keeps putting green into it. So I think we are at that tipping point, at least in some classes where where this is obvious. So I think if somebody really doesn't want to offer something, let him not do it, right? Because nobody will be happy. You will never get interest alignment. Never.
Okay, and on that note, because it seems quite a good note to finish, can I ask you to thank my two speakers? And I'll thank you for your questions. So if you could show your appreciation in the usual way. Thank you. And the burning question at the start was they are not LED lights because the heat coming off them is immense. So I'm quite grateful that I'm going to leave the stage and leave the climate change experts to take the heat.